In today's video, I'm going to teach you supply and demand from the ground up, what it actually is, why it works, and there's one reason it works that almost nobody bothers to explain. And once you see it, you're going to look at charts completely differently. How to find these zones on literally any chart in any market, and how to turn them into a simple, repeatable strategy that keeps you on the right side of the market instead of getting run over by it. We're going to go all the way from what a supply and demand zone even is, to how you mark them, how you tell a great zone from a garbage one, the one golden rule that ties the whole thing together, and finally, exactly how to place the entry, the stop, and the target. We're dissecting the entire thing today. And this isn't theory I read in a book somewhere. This is what I've been trading and refining over my 10-year trading career. Since I'm pouring all of that into one video for absolutely free, it would be awesome if you could just smash that like button for me to help out with the YouTube algorithm. If you're new here, go ahead and click that subscribe button, because we come out with content like this each and every week. What supply and demand actually is. All right, let's start with what supply and demand actually means, because most people get this wrong from the very first step. I'm going to say this really slowly so that anybody who's brand new will easily understand. Supply and demand is not about how many buyers or sellers are in the market. It's about how much buying or selling is happening. And that little difference right there is everything. You don't need millions of traders at one price to move a market. You need a handful of very large players slamming enormous orders in at one specific level. That's what shoves price violently in one direction. So when I say demand, I'm talking about a large buying move, a spot on the chart where price rocketed straight up because big money stepped in and bought aggressively. And when I say supply, I'm talking about a large selling move, a spot where price collapsed because big money dumped into the market. Now here's the part almost nobody explains, and it's the whole reason this strategy works. When a large institution wants to buy, they can't just click buy one time and fill their entire position instantly. Their order is way too big. If they tried, they'd shove price straight up against themselves and end up with a terrible average entry. So what do? They buy what they can, price runs away from them, and they're left with a bunch of unfilled orders just sitting there at that level. That leftover interest is what creates a zone. So when price eventually comes back down to that area, those remaining orders are still sitting there waiting, and they get filled, which shoves price away all over again. That's the entire secret right there. A supply or demand zone is nothing more than an area where big money left business unfinished. And our whole job, the entire strategy, is just to show up when they come back to finish it. Now, I know that might sound like a lot if it's your first time hearing it. If it did, do yourself a favor. Rewind about 30 seconds and watch that part one more time. You'll be surprised how much more you pick up on the second go, because once that clicks, everything after this is easy. Here's another way to think about it that really makes it lock in. Look at any strong demand zone, a price where the market took off to the upside. That range is a price that buyers were happy to pay. They saw value there. And here's the logic. If a price was seen as good value in the past, what do you think happens when price comes back to it? There's a strong chance it gets seen as good value again. So when price drops back down into that range, we're basically getting handed a chance to buy at a discount, to grab ourselves a bargain at a level big money already proved they care about. And the exact same logic runs in reverse for supply. The top of a large selling move is a price that sellers were happy to sell at. When price rallies back up into that range, those sellers are likely to step in again, and we can look to sell at a premium. Now that tight little range, the base of a demand move or the top of a supply move, that's what we call a zone. A demand zone sits at the bottom, where the buying kicked off. A supply zone sits at the top, where the selling kicked off. And what we want is dead simple. We want price to leave the zone, go off and do its thing, and then come back. When it comes back into a demand zone, we've got a well-priced level to buy from. When it comes back into a supply zone, we've got a well-priced level to sell from. That's it. How to mark your zones. So how do you actually mark these zones on a chart? Let me give you two methods. The first one is the traditional rule you'll hear everywhere in the trading community. To draw a demand zone, you use the last down candle before the up move. To draw a supply zone, You use the last up candle before the down move. The idea is that this last opposing candle is the final trace of the losing side, right before the big players took over. It's clean, it's simple, and it works. The second one is the method I personally prefer, and I'll be straight up with you. I kind of taught myself supply and demand a little differently, so over time I built my own approach. Instead of that last opposing candle, I use the last candle before the impulse. The impulse is just that explosive move, up or down. So I mark the very last candle right before price takes off. Why do I do it that way? Because in a lot of cases, it gives you a zone that fully covers the origin of the move, which means your stop loss ends up sitting in a much safer spot. With the traditional method, I've watched wicks dip just below the zone and stop people out right before the real move took off. Marking that candle before the impulse can be the difference between getting shaken out and staying in the trade. Now, I'm not sitting here telling you my way is right and everybody else is wrong. Both methods genuinely work. Pick the one that fits how you see the chart, and then, and this is the important part, stay consistent with it. And that word right there, consistent, is the whole game. Unless you have a rule for how you mark these zones, they're subjective, and two people will draw them two different ways. And to have consistency in our trading, we have to be objective. Consistency matters far more than which rule you actually picked. And here's a practical little tip for messy price action. Sometimes the candles are so choppy and ugly that no single candle gives you a clean zone. In those situations, use the wick of the move. A big wick will usually cover the entire range where the reaction happened, so marking that whole wick gives you a high probability area to trade from. Don't sit there trying to force a perfect textbook zone onto price that just isn't cooperating with you. Use the wick to capture the real reaction and move on. What makes a high quality zone? Now, not every zone is created equal, and this is exactly where you separate the good trades from the bad ones. So here's exactly what I'm looking for in a high quality zone. First, a strong, aggressive departure. The move away from the zone should be sharp and impulsive. Big, decisive candles, not some slow, lazy drift. A violent exit tells you real money was behind it, and that means real unfilled orders are probably sitting there waiting. Second, imbalance. When price moves so fast that buyers and sellers didn't get to trade evenly, when one side completely steamrolls the other and leaves a gap behind in the process, that's called imbalance. And you'll also hear it called a fair value gap. Strong zones usually leave imbalance behind on the way out. It's basically a fingerprint of urgency, and price will often want to come back and fill those imbalanced areas later on. Third, freshness. A zone that price hasn't come back to yet is called a fresh zone, and fresh zones are the strongest ones you'll find. Every single time price taps a zone, some of those leftover orders get filled, and the zone gets a little weaker. So the very first return to a zone is usually the highest probability one. A zone that's already been tested 2 or 3 times has probably burned through most of its fuel. And finally, you've got to understand this. Not every zone is going to get hit. Some of them will just sit there and never see price come back at all. And that's completely fine. That's just the nature of probability in trading. You're gonna miss some moves. It's gonna happen. You don't need every zone to work. You need to trade the good ones, in line with the trend, and let probability do its job across a whole bunch of trades. The golden rule: trade with the trend. Okay, this next part is the single most important thing in the entire video. If you take nothing else away from today, take this one. You can only trade supply and demand with market structure. Zones show up absolutely everywhere on a chart. In uptrends, in downtrends, in ranges, all over the place. If you just trade every zone you see, you will get chopped to absolute pieces. The zones themselves don't tell you what to do, the trend does. So let's define trend using structure. In an uptrend, price makes higher highs and higher lows. Each push up travels further than the last, and each pullback stops higher than the last. In a downtrend, it's the exact opposite. Lower lows and lower highs. And a break of structure, a BOS, is the moment price breaks that pattern. So, for example, in a downtrend, price finally pushes up and breaks above that previous lower high. That break of structure is often your first clue that the trend might be shifting, and it's one of the best confirmation tools you've got. Now, here's the rule that ties this whole thing together. So if the market is in an uptrend, and I want you to think about this, do you think we should be buying or selling? That's right. In an uptrend, you only buy demand zones. You completely ignore the supply zones. Do not try to sell them. Because if you try to sell into an uptrend, the market is going to run you over again and again and again, and you'll stack up losses fast. And in a downtrend, you flip the whole thing. You only sell supply zones, and you ignore every single demand zone. Fighting the trend is the fastest way to blow an account, plain and simple. Think of it like a river. Supply and demand zones are your spots to step into the water, but you always step in facing downstream. You move with the current, never against it. When the trend is up, demand zones are your entries. When the trend is down, supply zones are your entries. That one filter, all by itself, will wipe out the majority of your bad trades before you even place them. So now you know how to find zones and how to filter them with the trend. Let's talk about actually placing the trade, the entry, the stop, and the target. Your entry is the zone itself. In an uptrend, you set your buy order at the demand zone and you wait for price to come back to you. You do not chase. I'll say that again. You do not chase. You let price come back to your level. Your stop loss goes just beyond the zone. If you're buying a demand zone, your stop sits just beneath the low of the move that created it. And the logic is simple. If price trades cleanly below the zone, your reason for the trade is gone. The level failed. And when your reason is gone, you want to be out quickly and cheaply. Now here's something a ton of traders completely miss. Supply and demand isn't just for entries, it's also for your targets. Some of the best places to take profit are opposing zones and imbalances further along the chart. So if you buy from a demand zone, you can target the next supply zone, or the next big imbalance sitting above you as your take profit. Price is naturally drawn to those areas, which makes them logical, high probability targets. And let's talk about how we actually measure trades, because this right here is what makes the whole strategy sustainable. We measure everything in R, and R is simply your risk, the distance from your entry to your stop loss. So if you risk 1 R and the trade travels 3 times that distance to your target, that's a 3R trade. And because good zones let you place a nice, tight stop right at the edge of the level while you target a zone far, far away, supply and demand naturally hands you trades where your reward absolutely dwarfs your risk, which means, and this is the beautiful part, you can lose more trades than you win and still come out profitable, as long as your winners are worth several R each. That asymmetry is the entire mathematical edge. That's the whole thing. And one more thing you can do, set multiple targets. Instead of just one take profit, you can scale out. Take some profit at the first zone, take some at the next one, and let a final chunk run all the way to your furthest target. That locks in gains along the way, while still keeping you exposed to a bigger move if it decides to come. Quick but powerful point here. Supply and demand is fractal. That just means it behaves the exact same way on every single time frame. The 1-minute chart, the 5-minute, the 4-hour, the daily, the concept is identical everywhere you look. If you're a day trader, you can run this on the 1 and 5-minute. If you're a swing trader, use the 4-hour and the daily. You can even combine them. Use the higher time frame to define your trend in your major zones, then drop down to a lower time frame to fine-tune a nice, precise entry. The strategy adapts to your style. You don't have to adapt to it. So let me stack the whole system together in one clean sequence. And do you see how everything's coming together here? 1. Identify the trend using market structure. Higher highs and higher lows, or lower lows and lower highs. 2. In that direction only, mark your zones using the last candle before the impulse. 3. Wait for price to come back into a fresh, high-quality zone that left strong imbalance behind. 4. Enter at the zone. Place your stop just beyond it and target the next opposing zone or imbalance. 5. Manage the trade in R and let your winners run. That's the whole system, start to finish. And before I let you go, 3 mistakes I need you to avoid. Number 1, don't trade against the trend. Yes, I've now said it 3 separate times, and that's exactly how important it is. Number 2, don't keep hammering the same zone after it's already been tapped a few times. Respect fresh zones. And number 3, never ever move your stop loss further away just because price is going against you. If the level fails, take the small loss and move on. And listen, if you're struggling with this stuff right now, I've been exactly where you are. I struggled for over a year before I ever became consistent. I made every mistake in the book. I moved my stops, I used trash risk management, I traded strategies that didn't work, and I damn near blew my whole account before it finally clicked. So learn from that. Protecting your capital is the entire game, and that's supply and demand. It's genuinely one of the simplest, most powerful ways to read a chart, because instead of guessing, you're just following the footprints big money leaves behind and positioning yourself with the trend. But knowing it isn't the same as trusting it. So here's your homework, and I actually want you to do this one. Open up a chart, scroll back through the history, and mark these zones out for yourself. Find the trend, mark the zones in that direction, and watch how price reacts when it comes back. Backtest it until the pattern becomes flat out obvious to your own eyes. That's how this goes from a video you watched to a skill you actually own. One honest note before you go. No strategy wins every time, and everything I've shown you today carries real risk. Never risk money you can't afford to lose. And please, treat this as education, not financial advice. Prove it to yourself first and manage your risk carefully. If this helped you out, hit that subscribe button. I break down concepts exactly like this every single week. Now go put in the reps. I hope you trade green, and I'll see you in the next one.